that equalizes the prices of internationally traded goods across countries. Now, what exactly does that mean? Well, there's a group of economists at something called the International Comparison Program, which is run under the auspices of the World Bank. And they sit down and they calculate the PPP exchange rate for all countries. What they do is they look at a basket of internationally tradable goods, things like color televisions and wheat and oil, and they do detailed studies of what these look like in a whole bunch of different countries. Then they say, whatever the exchange rate is, that would be the PPP exchange rate, is the exchange rate we're buying that basket of goods will be the same cost in each different country. Their argument is that the exchange rate has to go to the purchasing power parity rate in the long run. If it was true that a whole bunch of internationally traded goods were cheaper in one country than in another country at the existing exchange rate, then somebody could make money by buying in the cheap country and selling in the expensive one. So that can't be a long-run equilibrium. It can't be a balancing point for the exchange rate. Eventually, buying in cheap countries and selling in expensive ones would alter the quantities demanded and supplied in a way that would lead the exchange rate to move toward the purchasing power parity rate. This theory of purchasing power parity also implies that exchange rates will adjust for differences in inflation between countries. Because after all, purchasing power parity is linked to the actual purchasing power of goods and services. If your country, say, had 5% higher inflation in this group of internationally traded goods every year, over time you would expect the exchange rate for that country to depreciate or weaken by 5% every year. In effect, your money's buying 5% less every year relative to other countries, so your currency will also buy 5% less every year relative to other countries. And that will keep the purchasing power parity exchange rate in effect. But in the short and medium run, exchange rates are often not near the purchasing power parity level. Instead, they fluctuate up and down quite dramatically. In the short and medium run, exchange rates are largely driven by changing expectations about rates of return, which can then lead to a lot of volatility. The total traded on foreign exchange rate markets in the early 2000s is roughly $1.2 trillion per day. 1.2 trillion with a T dollars per day. That's an extraordinary volume. Total global exports in the world economy are something like $9 trillion per year. Clearly, a lot of currency is being traded that doesn't involve the needs of buying and selling goods and services. Instead, it's about financial investment in one form or another. It's about people saying, what will give me a higher rate of return? An investment in the United States or in Europe or Brazil or in Russia? And the answer will depend partly on the existing rates of return, but it will also depend on what you expect exchange rates to be in the future. After all, if I'm a U.S. investor, it doesn't do me any good to go to Brazil and get a 20% rate of return if Brazil's currency depreciates by 30%. Because when I try and convert back to U.S. dollars, that depreciation of the currency will more than offset any gains I had. So when people think about investing in other countries, they're thinking about, do I expect the exchange rate in that other country to get stronger? If I do think it's going to get stronger, I'm going to go put money in that country. And that behavior sets up a cycle of self-fulfilling expectations. If people think a currency is going to strengthen, they're going to go invest in that country. And as they go to that country and they invest in it, the greater demand for that currency will cause it to strengthen, as they were expecting in the first place. So people expect a stronger currency, they invest seeking a stronger currency, and then the result is the currency does get stronger. But this sort of cycle of self-fulfilling expectations can't go on forever. At some point, the exchange rate needs to get back to its purchasing power parity level, so it falls back. We called this kind of behavior a bubble before, where people are investing based on an expectation that the price will keep going up, not based on fundamental market factors. There's lots of little mini bubbles going up and down in exchange rate markets all the time. Well, what should be public policy with regard to exchange rates? One policy is, let the market determine the exchange rate. Just let supply and demand do it. And this is basically the United States policy with regard to exchange rates most of the time. The argument for this policy is, yeah, exchange rates go up and down. So what? Oil prices go up and down. Interest rates go up and down. In the rest of the economy, some costs like health and education seem to just keep going up. Other costs like computer and telecommunications technology keep falling. Prices move in a market economy. Get used to it. The difficulty with this sort of laissez-faire policy is that exchange rate markets are really quite volatile. Even if the mammoth U.S. economy can more or less just let its exchange rate go, it may be that there are smaller countries who are importing and exporting half or more of GDP. And they're just not going to be comfortable letting the exchange rate move that much. It has too great an effect on too much of their economy. Well, what happens if a government seeks to manage its exchange rate? If it wants to do that, it should generally seek a stable or a slowly moving exchange rate over time. After all, a stable exchange rate helps create a stable business environment for trade and for long-term investment. And the logic here is similar to some of the reasons for a low inflation economic environment. You want firms to focus on increasing productivity and thinking about their comparative advantage in global markets. You don't want firms thinking about how to protect themselves against exchange rate movements or how to profit as exchange rates go up and down. I mean, imagine if the U.S. economy had 50 separate state currencies. It would be crazy to trade between states. Essentially, a common currency across the United States is a permanent fixed exchange rate across states. A California dollar is equal to a New York dollar is equal to a Texas dollar. But this business of trying to trade with many, many different currencies is the reality for, say, Latin America or Africa, and it was the reality for much of Europe until the introduction of the euro changed things and made much of that continent under one currency. So a goal might be to try and keep the currency somewhat stable. It's sometimes proposed a nation should depreciate its currency to help its exporters become more competitive and create more jobs. Well, it's true that a weaker currency will help exporters, as we talked about, and sometimes it does make sense for a currency to decline in value, maybe because a country's been having relatively high inflation, so the purchasing power of its currency should diminish. But depreciating currency is not a road to economic growth and a high-income national economy. After all, a weaker currency makes exporters more competitive, essentially by paying workers less. It makes the money that workers earn worth less in international markets. Also, a weaker currency hurts all the firms that are purchasing imported products, like imported oil. And there's a lot of firms in that category. As a long-term strategy, you can't continually depreciate your currency. I mean, if some depreciation of your currency is good, where does it end? Are we saying here, if your currency was worth nothing, then you would be super rich? I mean, I suppose that just isn't going to make any sense. A government might seek to control exchange rates, and when it seeks to do that, one way of doing it is to try and use monetary policy. If you use contractionary monetary policy, then a country can raise its exchange rate, or its interest rate. If you raise your interest rate, that will strengthen your exchange rate because people will want to invest in your currency for the higher rate of return. Conversely, an expansionary monetary policy can reduce your interest rates, and that will make your currency less attractive to foreign investors and weaken your exchange rate. The difficulty, though, is if monetary policy is used for this purpose, then you can't simultaneously use it for fighting inflation or fighting unemployment. Monetary policy is only one tool. It can't do everything. So a country which focuses its monetary policy on exchange rates may find that sometimes it would prefer to be using monetary policy for some other purpose. For example, imagine a country that suffers a negative economic shock of some kind, so it has a recession and high unemployment. No one wants to invest in that country, and so its exchange rate starts falling. No one is demanding its currency. If they want to keep their exchange rate up, they'll need a contractionary monetary policy to make interest rates high and make their exchange rate and their currency more attractive. But that contractionary monetary policy will make their recession worse. And faced with that trade-off, most countries will try and help their domestic economy, not their exchange rate. An alternative method for government to try and affect exchange rates other than monetary policy is to buy and sell its own currency directly on foreign exchange markets. For example, a country that wants to strengthen its currency could just buy its own currency on foreign exchange markets. A country that wanted to weaken its currency could sell its own currency on foreign exchange markets. But this direct approach, buying and selling your currency, has its limits too. When a country sells its own currency, what does it get? Well, it gets foreign reserves of some other currency, like the US dollar. What about if a country buys its own currency? If it wants to buy currency, well, it needs something to buy it with. And so it needs to have some reserves of a foreign currency, like the US dollar, in order to buy its own currency. Well, what that means in effect is a country can keep selling its own currency as long as it's willing to keep building up foreign exchange reserves. But at some point, this is going to look a little crazy. The country's just accumulating US dollars. On the other side, you can't buy your own currency forever. At some point, you run out of foreign exchange reserves to keep buying currency. So you can buy and sell your own currency, but there are sort of natural limits to how far that can go. And it tends to be much more a short-term, quick-hit process than a long-term policy. All government attempts to manage exchange rates run into two practical problems. One is that foreign exchange markets will attempt to outguess the government, and it's never completely clear what exchange rate the government should choose. Imagine that the government is attempting to stabilize an exchange rate, but investors in the international markets are trying to guess in advance what the central bank is likely to do. For example, what if foreign investors expect government to cause a currency to fall? Well, if they expect the currency to fall, they'll sell that currency and cause it to fall in the first place. Then if the government changes its mind and decides that it's not going to, then investors may say, well, okay, now we'll buy it again, and the currency is going to go back up. So beliefs about what the government might do can actually make the exchange rate quite volatile in the short term. Moreover, it's hard for governments to choose a realistic exchange rate. In the long run, a currency needs to reflect purchasing power parity. It needs to reflect what it can buy. But if the government tries to fix the currency at an unrealistic level, too high or too low, it's going to create imbalances and financial stress. For example, let's say that the government tries to keep the exchange rate too strong. Then over time, it's going to have very weak exports and very large trade deficits over a sustained period. If the government keeps the currency too weak, then it's going to have large trade surpluses and a continual outflow of investment capital. Again, speculators will begin to anticipate the currency is going to move. The government would then have to step in and use either interest rates or direct buying and selling to discourage the speculators. And at some point, it just becomes crazy to be trying to move interest rates back and forth, keep buying and selling currency forever. So some countries have attempted to keep their exchange rate more stable than the market outcome, but they've recognized that trying to keep it completely fixed is difficult, and they've allowed their currency to move a little bit back and forth over time. The general wisdom in the mid-2000s is that this policy, although it sounds very sensible, it sounds sort of intermediate, may not make a lot of sense. The problem is that when government starts saying, we're going to try and keep the exchange rate roughly fixed, it often leads to very, very little variation in exchange rates for a long time. So firms and banks in the economy begin to act as if exchange rates were really fixed in one place. But then when the exchange rate does move, it moves dramatically. And the effects are especially painful because firms and banks haven't planned and hedged against a possible change in exchange rates. Thus, the argument goes, it's better either to be clear that the exchange rate is always flexible or that it's always fixed. But choosing a sort of in-between, sometimes it'll move, sometimes it won't, we'll kind of figure it out as we go along, may end up being the worst policy of all. So overall, what do we think about exchange rate policy? I'm afraid I don't have any real clear, clean lessons for you here. But certainly one step would be that an economy should avoid inflation to avoid sort of big shifts in the foreign exchange market. It should avoid huge trade imbalances, which can also bring about big movements in supply and demand for exchange rates. An economy can either choose to let its exchange rates float, or it can choose to fix its exchange rates. But it probably shouldn't hang out in the middle ground, kind of sometimes letting them move and sometimes not in an unpredictable manner. Many of the international financial crashes we'll discuss in the next lecture occurred in countries that had sort of promised to keep their exchange rates in one place, but then left their firms and their workers and their economy unprepared for changes in the exchange rate when they actually happened.